Hey traders, Steven Kowitzel here with thetradersplan.com. Happy Thursday, headed into the close. Got a lot to cover today. I know we say that all the time, but we are going to talk about the market in a potential reversal or pullback mode. We're going to analyze that. We're going to look at some of the things that aren't working, but just as importantly, some of the things that are. So we've had some sectors that are starting to emerge and have already emerged and are starting to pull back. So I'm looking at opportunities headed into the summer months. So we really want to pay attention to what's showing strength, and let's focus on that. So towards the end of this, you're going to want to stick around because we're going to look at a lot of stocks that I think are really the strongest in the market and some potential entries for those. But before that, let's look at a disclosure real quick to make sure that don't go buy anything, do your own research, that good stuff, make the lawyers happy. Okay, so let's start with the NASDAQ, then we'll go to the S&P 500. We'll start with the overall market first. A lot of times, and if you watch my webinars, you know how I feel about rallies coming out of corrections. Rallies coming out of corrections are typically very, very strong, as it has been, right? I started getting in right here, somewhere around here, and just by here, I was fully invested in just ride this trend. Well, a lot of times, sometimes they can last a long time, sometimes they cannot, but I always try to say stay with your strongest stocks as long as you can until the rally is over. Once you start to notice the rally is over, you want to definitely have your stop losses raised and make sure you protect some capital because you don't want to blow through all the money that all these gains that you just made and give it all back if the market just rolls over. A lot of times, just studying these rallies, I noticed that you typically will get two successful tests of the 20-day moving average. A normal rally will test it twice, and then once it pops off that test of the 20-day moving average, it's kind of selling into the strength is not a bad idea, or taking some profits as it's coming out of the successful second test. Now, some will have 2 and 3, but I'm just talking about booking a little bit of profits off the table. So the NASDAQ came down and just gave the 20-day moving average a kiss, and this would have been on Tuesday, reversed nicely. That was perfect. Gapped up the next day. Well, now it's reversing kind of in an ugly way, so it's looking like it wants to just probably chop around. Could eventually break the 20-day moving average, but how I play that is it's not over till it's over because I've seen it continue to chop around and continue its uptrend. So I try to stay a bull as long as I can. Even, Peter Lynch says there's more money lost, preparing for a bear market than there's actually losing money in the actual bear market itself. So, I'm starting to see some distribution down here. The NASDAQ is really strong. Tech stocks have been really pushing up this market. So now that I know that we've had 2 successful tests, and history tells us anything, there's typically chop after it breaks to a new high after that second test. I'm just going to have a little a caution sign. I will say that. And the caution sign doesn't mean we're coming all the way back down to here. It just means that if you're looking to play some trades or put a little more money to work, I think the market can come to you and get a little bit cheaper. So it's just a little frothy, a little extended, which is okay. That can happen. You want to try to stay in your strongest positions, sell half, raise your stop to break even, that kind of thing. It's always the best trading rule is if you don't know where to get out, if you got something, you're sitting on a pretty good chunk of profits and you don't know what to do, something I've always done, might not be right for you, sell half, raise the stop to break even. So if you sell half at 10 and then you raise your stop to break even if the stock absolutely rolls over and comes and triggers your break even spot, you still netted 5% because you got 10% on your first half, 0 on your second half, netted 5%. However, if you get that 10% and it continues to take off, you still have half in play, so you can let it run for a little bit. Maybe get a 20 or 30% gain. So right now, I have the caution flag right now. It's because distribution is clearly coming into the market. A lot of times I will hold off at least for a minute on putting new positions for like a day or two, a couple days until I see it. Now the S&P 500. It's right on the 20-day line. 20-day EMA is 27.54, and we're at 27.52. So, it's likely that it'll close above 27.54. I think it will, but It is right at this trend. So it broke out of this descending triangle, came back, entry right there, tested it, and shakeout. And then is back at this trend line and back at the 20-day EMA. So S&P 500 is, to me, it's a better representation of the overall market because it's just more diversified versus the NASDAQ or the NASDAQ 100, which is mostly tech and small cap and things like that. So right now it is, weakening. So we want to keep our eye on that. If the NASDAQ is holding the 20-day and the S&P slightly break, I'll try to pay attention to the NASDAQ, but I have them both at top of mind. And if this cracks, in my opinion, rally is over, or at least it's just a deeper pause. So I try to keep a lot of things in mind, but at the end of the day, when trend lines start to crack, then I go to the market breadth. And I say, okay, if trend lines are cracking, we're entering that time of the year, what's happening to the market breadth and where's the money flowing into? Is the money flowing into defense or is the money, staying with aggressive? And we're going to answer that here in a minute. So keeping an eye on everything, but, the NASDAQ the S&P could bounce from here, but again, just be really cautious right now. And if the market pops on Monday, great. If it clears this little pivot from Wednesday, great. Maybe the rally resumes. But sometimes I have no problem paying an extra point or two to get that extra confirmation because I think the advantage comes in trading is your risk management and your money management rules. Most people are good stock pickers, right? It's from, the money management and the trade management. That's what's going to give you an edge. That's what's going to make you beat the house, right? You don't need a big edge. You just need an edge to beat the house. Let's look at the USD. Weekly chart, US dollar, incredibly strong. It's really hard to argue. It is coming, breaking through this zone right here, 94.72, it's 94.86, so right in here, right in this zone. Could it come down and create another consolidation? Yes. Could this just be a counter trend rally? Yes. But here's what I do know. I know it broke out and cleared a pivot and is marching higher. So do I think this is going to go straight up? Absolutely not. But to me, it's looking like more of it's a trend reversal than just a counter trend rally. And I'm also basing that based on everything else that is happening. Emerging markets is rolling over. I mean, absolutely rolling over. You want to get out of the way of that freight train. We're going to talk a little bit more about that, and then we're going to get into what's strong. But the S&P 500 broke out relative to the emerging markets, broke out relative to international markets. Small caps are leading the S&P 500. So small caps are beating the S&P 500, that's beating international and world stocks. So when these leadership change takes roll, to me, I'm just getting out. Like, I'm just going with the strongest one. It's just a momentum-based strategy, right? I want to be in the strongest stuff. Because it's like Sir Isaac Newton, the motion law. What I don't know how to say it, but what starts in motion stays in motion, right? And that's really the thought. I probably totally botched that, but I think you get what I'm trying to say. From a momentum-based style, you want to focus on what's being strong because strength follows strength, weakness follows weakness. So why be in the weaker one? So the dollar is crushing other things out there, and let's look at the CRB SPX. Okay. So a couple weeks ago, I showed this chart where you had the CRB relative ratio to the S&P 500, and it was breaking out. You had this bottoming rectangle pattern. You had this pretty good downtrend line with plenty of touches, and it broke out. Everything was looking good, right? I was like, okay, commodities are breaking out relative to the S&P 500. Well, it's rolling back over. And this is why you can't just, make the switch. Whipsaws are going to happen. You have to be willing to switch back. So this is something worth watching. If it curls up, great. comes back and retests. If I were to extend this downtrend line, say it comes back and retests the trend line and then gets strong, that could possibly happen. I'm thinking that could happen. And I have a bias based on where we're at in the business cycle with interest rates rising and the commodities typically get strong. But, you know, it is when you get a breakout and the breakout fails, you need to pay attention and you need to say why, and take action on that. So the CRB relative to the S&P 500 got weaker, and it got weaker quick. And if we look at the CRB relative to the dollar, so the dollar, we just looked at that, right? The CRB, I could draw a trend line right here from the bottom of I'm going to call it June of 2017. Boy, it's on it. It is on that trend line, and it's touched it 1, 2, 3, 4 times. There's only so many times you can touch a trend line. So it pulled back hard. I'm not saying it's just going to roll over. All I'm saying is that with the dollar strong, the CRB was moving in line with the dollar right here, which is not normal. Normally they move opposite of each other, but the relationship decoupled and they moved together. And now the CRB is finally pulling back. I'm not going to say it's cracking, but I'll put it this way. It is vulnerable. It is vulnerable given the strength of the dollar and how many times it's probably touched this downtrend line for a deeper pullback. So with that being said, this is a chart of the Shanghai Stock Exchange, and I just think it's important to look at this. You have, let's say from 2014, let's say a 2.5-fold move, right? Almost a 3-bagger, right? Just in the index in a year and a half. That's kind of crazy. A 2.5-fold move in one stock exchange. Just how crazy it is over there sometimes. And just a 50% cut, right? So then you have this just grinding wedge. And it's amazing to me, even to me as many charts that I looked at, like how long this took. It tried to climb back, but it just grinded its way higher, and then it cracked this year, and it is cracking in a really, really big way. It went from 3560, the Shanghai, to 2900. So we'll call that, it's in a bear market now officially. So it's looking really, really ugly. That along with everything I just showed you with the dollar getting strong, and there's a lot of things that can play into this. One, the dollar makes the most obvious sense. It seems to me that even though commodities have gotten a little stronger, a lot of it could be that the emerging markets were strong, not necessarily because, they have a positive correlation with commodities, because commodities were still kept at bay, but could have been a lot of these countries were having technology that was making the emerging markets stronger instead of the commodities. So that's a possibility. But either way, that's cracking. And when something's cracking, it's just best to move to the sideline and wait. If you really like it, I'm not telling you to go out and sell it. I'm not making recommendations. I'm just putting this on the screen so you can see that the dollar is strong, commodities are weakening, emerging markets are just absolutely rolling over. And it's just something to pay attention to. The U.S. is stronger relative to all this stuff. So if you let's just look at EEM, Emerging Markets ETF, right? Let's just look at it on the same kind of chart. You can see it is really strong from 27 to 51. So that's a 90% move in 2 years, right? From early 16, early 18. Peaked with the market, never bounced with the market, which made sense because the dollar started getting strong here. It didn't follow. It rolled back over. So it makes sense as the dollar correlation. But now it's breaking. It broke this level, and it's breaking this level. So it's just looking like one big topping formation, and it could just undercut this, and this could be an excellent buying opportunity. I don't know, but all I'm saying is it's weak. It's weak, and it was looking weak, and now it's looking even weaker. So we've been in a bull market for several years. Sometimes we forget about some of the things that have happened and how deep corrections can go. U.S. market is looking strong, so I'm not comparing it to the U.S. market. All I'm just saying is that the emerging markets, when they get weak, they could have long-term cyclical cycles, and you probably just want to keep that in mind. And me personally, I want to get out of the way. I want to get out of the way. So if we look at, I wonder if I can just make this a full chart real quick. I remember why I didn't. That's okay. I'll save that. So if we look at the S&P breadth indicators, right? You have the S&P 500, and this is a chart I got off Arthur Hill with StockCharts.com. And you know how he does it is once a breadth thrust if the high-low indicator gets above 10. So we have a breadth thrust in, and it doesn't negate it until it gets to negative 10, okay, or in the negative territory. So this looks strong. Breadth is weakening, but it's not in the negative, so there's nothing really wrong there. Mid cap, same thing. You got a breadth thrust, new uptrend. Small caps, still, I mean, it's still looking strong. So small caps are just smoking everything. So is the NASDAQ 100. It is very, very strong, or just the NASDAQ. So the breadth is still looking just fine. Now, if we look at my favorite breadth indicator, it's just something incredibly simple. It's just what percent of stocks are above the 200-day moving average, and in the S&P 500, and we're still above 67%. Hard to get too bearish, right? It's still in bullish territory. Yes, sure, you want 80, 90%, but I mean, that's not realistic all the time, right? The market, I mean, what we had from, you know, the presidential cycle to this year, I mean, that's not normal. You have to realize that you'll get into more normal market conditions. So still bullish. I don't pay attention to the short term because it's just, I'm looking for less signals, but not more. But I would say breadth is still good. And we'll just kind of keep our eye on it day by day, week by week. So a lot of times when the market, if the price trumps everything, no pun intended. So when the price starts to break or slows down, I look at breadth and I look at where the money is rotating. Where the money is rotating and breadth are secondary indicators. I don't make immediate decisions on them. But if I am seeing breadth weakening or absolutely rolling over while the market's kind of hanging in there, and I'm seeing money moving into utilities, sometimes I will hold off on new positions. Doesn't mean I'm going to go out and sell everything, but I might hold off on new positions until the market has a come to Jesus meeting one way or the other. So I want to look at a couple more things that are weak, and then we're going to look at some things that are strong. Let's just look at gold for a second. Let's look at gold miners, and we'll look at gold, and then we'll look at oil. So you have GLD up here in this top pane. This broke its downtrend, broke the horizontal, and is just getting weaker from 128 to 120 GLD, the ETF. So, I mean, there's nothing too wrong with that. I bet I could draw another trend line right across here, and that broke too. But it's weakening. It's weakening, which makes sense given the dollar. Now, GDX, I would just stay away from it. It is weakening too. Like, it just made a surge. That steep trend line broke, and it made a lower high right here, and then rolled over, and it continues. Right now, it's making lower highs. And I don't know if I'd say go out and short this thing. I'm not telling you to go out and short it, but I'm not saying if it's a good short setup. But it just continues to enter the zone of no man's land. So it's trendless. It really is. And you have the GDX versus the GLD ratio, the miners versus the metal. Greg Schnell with Stock Charts also likes to focus on when it breaks out, the miners break out relative to the metal you want to be long. And it did right here, and it's just kind of going sideways. It really hasn't done much. So it kind of confirms. I know a lot of people like gold. They like to talk about gold, but there's nothing really to talk about here. It's weakening, but it hasn't cracked wide open one way or the other. So, but it's getting kind of interesting too, with the dollar getting stronger, gold weakening, and then you have this, chart of gold that goes all the way back from 2000. This is the gold contracts. This is an ETF. So I thought it was, so it broke out of this downtrend line that went all the way back to 2011. It broke out, came back, retested, was taking a crack at the late 2015 high and just couldn't do it. It just couldn't do it, and now it's rolling over. So I could probably draw a trend line right across here. As a matter of fact, let me kind of do that and see what that looks like. I could probably draw a trend line right across here, and that's breaking as well. So I'd stay away from it from the time being. I don't know if I'd short it, but I'd probably stay away from it. Yeah, we'll keep that there. Or let me just say this. I am staying away from it because I can't get a read on it, and it's not looking strong. So the oil was strong, and then it pulled back, and it could be curling back up. So I'm not going to write oil off right now because it just made a monster move, right? It went all the way from 42. This is West Texas up here, all the way from 42 to 72. I mean, it deserves a breather, so it might do what it did here. Pull back, will consolidate for 5-6 months, then it'll take another leg higher. I don't know, but the XES ETF, it already retraced half of this move, at least. It made a 35% move right here. It's already back here. I don't know if this is going to hold or not. It's coming in. I wouldn't really pay attention much to the moving averages because this is an ETF, a basket of stocks. But it's coming into this zone, this $16 zone, right? This seemed to be resistance right here. So, but to me, it's kind of looking like it wants to take another leg lower. But it looks weak. It's in a downtrend. So if you want to catch a falling knife, I'd have a tight stop right here. But it's just, again, it's not really interesting to me right now. And even though I'm not against buying on pullbacks, I'd say this is probably, if you like pullbacks, you like retracement, this might not be a bad zone to look at. But just commodities are looking weak in general, so there are other things that are looking stronger right now. Let's go, and the NASDAQ is getting weaker into the close. Let's go look at the sector summary, then we'll look at the industry. Utilities, staples, leading today. It's not really a surprise. Let me get a different view here. Take that off. Let's just look at the last 5 days. That's just because it's what I like to look at. Now, this does not include today. But staples, utilities are leading. So, we have right now price action, the trend lines that could be breaking. Let's say they're steep trend lines, so it wouldn't be the end of the world if the 20-day moving average breaks. It just means that the rally isn't that strong anymore. Okay, money is moving into this the more defensive areas. So you have healthcare is doing good, which we're going to look at that in a minute. Cyclicals are up there too, and that's a positive. But staples and utilities are leading today. They're leading for the week. Maybe people are getting ready for the July, August, September months, typically the 3, 4 and headed into October, the worst time of the year. So it's all something you want to look at the weight of the evidence. The weight of evidence is telling me right now that there could be a caution flag out there with the 20-day line breaking and money is moving into more defensive areas. It could need a breather. So when I look at this, I'm not out there, like the movie Chicken Little, screaming the sky's falling. I'm just saying this, the market needs a breather. It made a nice move. I made a lot of money off this most recent trend, as I know a lot of you have. So it doesn't go straight up. It's not the end of the world if the market takes a break. So let's look at more individual industries. Go. So retailers are strong. So I'm in the 1 week. I don't think this is including today, but retailers are strong. That's a positive. Within the cyclicals, we just saw the cyclicals were strong. Technology still has some pockets of strength, but you can see probably the breadth is weakening a little bit this week, just this week. Industrial is weak this week. You can see all the red. Materials are getting slaughtered. Metals, mining, gold mining, all that good stuff, that's all getting slaughtered. Energy is rolling over. Pipelines are positive for the week, but for the most part, you know, you have the sector and then you have the individual industries. And this is why I try to find the individual industries, because like if pipelines could be positive, you don't want to buy the whole sector. If you want to buy pipelines, you know, buy pipelines. You don't have to buy the whole sector because the rest of this is going to weigh it down. Consumer staples, yeah, the drugs, the foods, very consumer staple, defensive type stuff. Healthcare is, I wouldn't call it too weak because I want to make the case for healthcare. It's not down a lot. It's not down as much as some of this stuff, but it's down a little bit. Broad participation in utilities. Look, water, gas, multi-utilities, electricity. This is down, but I'd call that broad participation within the whole sector. So money is rotating into utilities. And we saw financials on the sector summary. It wasn't bad, wasn't great, but in financials, REITs are the only one with positive for the most part, and that is a defensive sector of the market because they're high dividend paying stocks. So it's crystal clear that money is rolling into, you know, the more defensive plays. The evidence is suggesting that from the sector rotation. But let's look at some things that I think have the potential to hold up, and some things that I think have the potential to be strong on the next uptrend. Let me move this over. So first I want to talk about some of the strongest software stocks out there. So the software industry, not the technology sector, but the software industry has been incredibly strong. And you have a lot of these software companies coming public, coming out of IPOs, and they are just taking off, just absolutely taking off. And yes, I missed a lot of them because like this one took off after earnings. I'm not gonna hold it through earnings, especially when it's an IPO. It's probably got a high valuation, but you know, it took off after that. Who knew? So it, you know, went from 18 to 35 very, very quickly. It doubled from this bottom to this top in a matter of 6 weeks. That's showing a lot of strength. Right now, it's pulling back to the 20-day moving average. I'm not telling you to go out and buy these. Just full disclosure, do your own homework. I'm just trying to show you some strong stocks in the market. And they have been getting hit the last several days. So this one, incredibly strong, down 9%, 5%, and 6% today. So there's two sides, right? There's the upside where everything's hunky-dory, champagnes are falling from the heavens, and then there's the downside. So is this going to find support at the 20-day moving average, which you pretty much call it its first test? I don't know because technology is coming. But what I do know is if this does create more of the weekly chart doesn't look good because it reversed high and is reversing down. But if it creates a consolidation and takes another leg up, that might be considered. Now, I want to show you something, and I always like IPOs. I like IPOs, and I try to trade them as much as I can. I like the new inventory to come on the market. So a lot of times what I'll do, and I'm going to show you what not to do. A lot of times what I like to do is if the IPO, if it pops and then it's trading sideways, it's being incredibly quiet like it is. I might put an alert I might pick a point on the chart and put an alert right as it crosses this pivot, right? So then it could continue to drift down like some IPOs do, but if it's strong, it'll create this pivot right here and then come back and then just take it out. You don't have to wait till it comes all the way up here, but it'll take it out. So a lot of times I'll put an alert as it crosses this, and if I really, really like the stock, you know, I'll just go ahead and put a buy stop order once it crosses that level to turn it into a market order and automatically buy me shares. And I put buy stop orders into stocks I really, really like that I think could potentially move very quickly and move without me unless I'm like glued to the screen. So you could put a buy stop order as it crosses this. That way you don't have to watch it. Now, this stock popped and then it was a shakeout. Tried to pop to a 52-week high or an all-time high. Shakeout, gave the 20-day moving average a kiss, and then took off. If you have seen my 5 cornerstones in the course, there's a video called The Shakeout. This is classic textbook, right? breakout of a cup, and it's typically in cut patterns, right? It breaks out a cup, undercuts that pivot, comes back, finds support at the closest moving average. There's your entry right there. Gives it a kiss. Now, again, I wouldn't have bought it because it was about to report, but it's classic. So two things you can learn from this chart. One, when you get an IPO and it's trading sideways and you like it, pick a spot in the middle of the cup. That way, it could go down and you could totally ignore it, but if it comes back around and takes that out, you can get in very, very early. And then it just absolutely takes off. But again, the strongest stocks are pulling back hard right now too. I don't know if this is going to be deeper or not because we have a lot of these to look at. But a lot of these software stocks, and the software sector is different than the security sector. And so it's really the software stocks that are just showing so much strength. You have very, very strong sales, very, very weak earnings. So they're just not profitable yet. And that just seems to be, that's not uncommon for technology stocks to come out with strong sales growth and not strong earnings growth to try to raise capital to get to profitability. But I wouldn't have bought it. But, sometimes it's just good to look at the big winners and just see how you could have played it. Could have played that right there. Pick a point, and then it just absolutely takes off. So let's look at a few more of what I think are some of the strongest stocks in the market right now. Another software stock. You got Pivotal Software. Very, very strong sales growth. The profits are not there. Now that's not going to keep me. If I see the strong sales growth, the earnings isn't going to keep me from buying it, but I pay attention to it. So there's something very similar happened right here. So it popped, and then it traded for the most part sideways. It created this cut pattern, right? And as it starts, you want to get in lower as it starts to climb the right side of the base. As you notice it's starting to curl, you want to try to pick a spot in the middle of the base. Now, there is no spot in this base, right? So you would have had to try to buy it as it curled, as the volume started to step in, and then earnings just absolutely gapped it up. But then look, this one's pulling back hard too. You have a nasty reversal right here. Yesterday it was down 6%. So, I mean, you have to have really good money management rules to sit through this, right? But again, it's a very strong stock. So let's take one, that hasn't really made a move yet, and Green Sky. Okay, so you have this isn't in the same sector, but it's just kind of an IPO. I'm looking at very strong return on equity, strong sales, spotty earnings, but I'm guessing with the return on equity, it's anticipated to continue to produce profits. Now, so you have this IPO, right? It's going down, as most IPOs do. They pop, now it's down to the IPO price. So what I'll do is I'll say, okay, I'm not trying to catch a falling knife, but let me pick a spot right here where it'll alert me and wake me back up, because this stock has some really strong fundamentals, but I don't want to buy early. I want to catch it as it is climbing certain pivots in the middle of its base. So I'll say, okay, that 25.23, that 24.90, 25.20. So let's just set an alert. GSKY. So say 25.25. So now it's going to send me an email alert when it comes back and it crosses above here. I'm not telling you to go out and buy it, but I'm just saying you can put alerts at certain spots where you think that it's turning around, and you don't want to buy it when it's all the way up here because you're going to get shaken out. You want to buy it as it's climbing early the right side, because when it tries to get up here and then shakes you out, well, you're already in it for down here, and you have a bigger profit cushion to maybe sell into the shakeout. So if you have a good profit cushion, you can sell as it's breaking out, and then when it pulls back and shakes you out, just like it did on ZUO, right? It came back, it broke out, came back, shook you out, came down and touched that 20-day moving average and took off. You already have a nice profit cushion, okay? So Dropbox is another. DBX. Okay. Look at this. Very strong. a lot of these I missed. I already had a full portfolio, but you know, I'm not buying it when it gets up here. I'm buying it as it's crossing these low-level pivots and above average volume. This one did get away from me because on this day before it broke out, I saw the volume stepping in and I considered it, and you know, it's just one of those mistakes, but it hadn't cleared it yet. And of course the next day it was up 14% and it was gone. And that's what happens with a lot of these stocks. You have to try to pick a place early because once it's gone, it's gone. Now it's trying to come back and retest the zone, and if I were a betting man, I would say it's going to come under this pivot, touch this 20-day moving average right here, and possibly find support. Now this could be a better stock because it's profitable. Okay. Plus, a lot of us know the Dropbox name. CS. Another software company that has really strong fundamentals, really strong sales, not really strong earnings. So, look, you could have, you know, set your pivot right here and bought on this day, and then it just absolutely takes off. But again, I'm showing these as examples, but I'm not going to buy something right before earnings. So it probably popped after earnings, but look, now it's coming back. It's sitting on this, and this is interesting. So is this a buy, or as it's touching the 20-day moving average? I don't know. This is kind of sloppy to me. I'm not buying it, but a lot of these just new IPOs, they are sloppy. So that's why it's better to look at the weekly chart. Another one, Smartsheet, another software company. So you can just see these suckers all after earnings, okay? But right there. Oops, that's not what I did. Right there, you can pick up, and it broke out in the same day. So it broke out, never looked back, and is now sitting on the 20-day moving average. So all these software stocks they just absolutely, you know, went on a 50% tear in a week or two, are pulling back, and they're pulling back pretty hard. Is it an opportunity or a threat? I have no idea. Because of the volatility, I would probably wait for a little bit more time to pass before I would consider. But, you know, it's just, it's all things to look at. And I just wanted to show you, you know, we looked at what's weak. We looked at emerging markets are weak. Commodities are weak. But there are some real pockets of strength out there. I want to look at MJ. And this is the marijuana ETF. I think this is an industry that just, it has the opportunity to buck the trend, and it is. This is up to, it's just an ETF, a basket of stocks. This isn't just a stock, this is a sector. You know, broke out of a downtrend, and we played this. Broke out of a downtrend. We bought it, I think, as it cleared this, and we sold it right in here. So we sold half here, we sold half here. So we got out early, but we have some other cannabis stocks that are doing just fine. And it came back, and it did test support. It tested this zone and is coming back to build the right side of a potential deep consolidation. Do I think this is just going to do this? No. It could be a grind like this. It could pause for a little. If we have bad summer months, it could pause above this 30 and, you know, just build a nice base and then take off, right? But I think this is, I always try to find stuff that can buck the trend, or fast-moving stocks, fast-moving industries, because what I have found is I used to pick, you know, stocks with good fundamentals, but they couldn't get you that 10% really quick. And I found I was losing the same amount on those as I was on the fast-moving stocks. So I'm like, well, why would I, you know, wait 2 months for a potential 10%, or, you know, maybe not that long, but when I can try to pick the stocks that can get there in 2 days. Because then if the market rolls over, you've already locked in half of your gains, right? So just little money management rules. I want to show you something that's really almost funny. If you want to feel good about yourself, just really good about yourself, you can watch this mistake. So this is another software stock. Now this is a Chinese company. Look at this. So I'm totally just busting on myself right now. Just because it was, I know I'm laughing about it, but I had it. You can see the alert right here. It was on. I had found a spot. I don't know why it continues to do that, but I found a spot. I found a pivot. Will it stop doing that? No, it's not. So I found a pivot that I liked. And I said, okay, it's going sideways. It could continue to drift lower, but if it curls around and breaks above this pivot, I'm going to consider it for a trade. Well, I got an alert that it crossed through the pivot. It came back down a few days after I played it. And I was like, you know what? I don't think I was at home or something. And I kind of forgot about it because I set alerts on a lot of them. And it literally tripled in 3 days. Like, you can't make this stuff up. So, be glad you're not me, because I literally watched this thing go from 5 to 15 in three days. And I'm not saying I would have bought it. I had the alert on it though. Like, everything was right. But for a lot of these stocks that I'll put these alerts on, if I really like the stock, I'll go ahead and put a buy as it crosses this level, for these faster moving ones. I'm not telling you to go out and buy this one, because this, I mean, I have no idea what's going on with this stock. It triples in 3 days. But my point is, it's just kind of funny because I look at it on what I could have had. It doubled the next 3 days and then tripled the next day. So, but it's in the software sector as well. It is a Chinese name, so I don't know how to. It doesn't look like it reports every quarter, so I don't really know how to analyze some of the companies where it doesn't report every quarter. It reports every other quarter, and so I probably would have passed on it anyways. But I have to laugh. I have to bust on myself a little bit. So if you're having a bad week, which I'm having a really good week actually in the market, even though the market's down, most of my stocks are up. If you're having a bad week, just be glad you didn't pull this mistake. But it's all good and fun. So I hope this was helpful. You know, we looked at what's weak, what's strong. We looked at the market, and we looked at, you know, a little strategy like this, especially with IPOs. And you can do this with other stocks. Like, don't wait till they break out. Pick a pivot in the middle of the base. And if volume steps in across the middle of that, to me, that's a better entry than waiting till it gets up here. So I think you have just as much, if you're like me and I don't like to risk a lot on a trade, you have just as much an opportunity to get shaken out right here as you do right here, and you got a lot better price. So why not try to get a little bit better of an entry before it before it triples on you? So I hope you have a great weekend. Let me know if you have any questions.